While the Federal Reserve is frantically cutting rates to keep the American economy on life support, something massive just happened on the other side of the world. Something that hasn't happened in 30 years. As of this morning, December 20th, 2025, the Bank of Japan didn't just blink, they pulled the trigger. They hiked interest rates to 0.75%. That might sound like pennies to an American dealing with 5% mortgages, but in the world of zero-interest Japan, that is a nuclear explosion. But here is the mystery: the BOJ finally gave the market exactly what it wanted, a unanimous rate hike. And the result? The Japanese yen didn't soar. It collapsed. The currency is bleeding out, crossing 157 to the dollar. Why? Because the market smells fear. And if you think this is just a Tokyo problem, check your 401k. Because if the Japanese carry trade unwinds the wrong way, the liquidity fueling Wall Street evaporates overnight. Let's peel back the layers. For decades, Japan was the land of free money. But inflation has finally embedded itself into their economy. Consumer prices are up 3% as of November, that's 44 straight months above their target. The deflationary ghost of the 1990s is dead. So, Governor Ueda and his board voted unanimously to hike rates. They see wages rising. They see the economy shrugging off the risks of President Trump's new tariffs. They even signaled that more hikes are coming, potentially hitting 1.5% by 2027. On paper, this is hawkish. This is aggressive. So why did the yen tank? Because in the high-stakes game of global macro, expectation is everything. Wall Street traders were betting on a shock-and-awe campaign. Instead, they got a wait-and-see speech. During the press conference, Ueda refused to define where the neutral rate is. He basically said, "We'll figure it out as we go." To a currency trader, that uncertainty is poison. The market interpreted his hesitation as weakness. They think the BOJ is terrified of breaking the economy, so traders immediately shorted the yen, driving it past 157.10. UBS economist Masamichi Adachi put it best: Ueda sounded like a guy who's ready to end the hiking cycle before it even really begins. But there's a deeper game being played here, and it involves Japan's new Prime Minister, Takaichi. When she took office in October, everyone thought the rate hikes were dead. She's a known advocate for easy money, keep the printers running, keep the rates low. But look at what happened today. She didn't stop the BOJ. Why? Because she's trapped. The weak yen is a double-edged sword. Sure, it helps Toyota sell cars in America, but it makes importing energy and food to Tokyo incredibly expensive. Voters are angry about the cost of living. Takaichi's party already took a beating in the last two elections. So, she's playing 4D chess. She's letting the BOJ be the bad guy by raising rates to fight inflation, but she's keeping the government spending high to keep the voters happy. It's a dangerous balancing act. The BOJ is trying to tap the brakes while the government is slamming the gas. Now, why should you, sitting in New York, London, or Toronto, care about Kazuo Ueda's press conference? 2 words: yield convergence. While Japan is hiking, the Federal Reserve has already cut rates 3 times this year. The gap between US interest rates and Japanese interest rates is shrinking. For the last 10 years, Japanese investors, who sit on trillions of dollars, have been sending their money to the US to buy our government debt and our stocks because they couldn't get a return at home. But today, the Japanese 10-year bond yield hit 2%. That's the highest since 1999. If Japanese pension funds decide that 2% risk-free at home is better than gambling on US Treasuries with a volatile dollar, they bring that money home. If that capital flight accelerates, US Treasury yields spike. When Treasury yields spike, US mortgage rates go up. Corporate borrowing costs go up. And the valuation of the S&P 500 goes down. We saw a preview of this in July 2024, the carry trade unwind that caused global chaos. The BOJ is trying to avoid a repeat, which is why they are moving so slowly. But make no mistake, the era of Japan funding the world's debt is ending. The BOJ is the outlier. They are the only major central bank hiking into a global slowdown. They are betting that their economy is finally strong enough to stand on its own without 0% crutches. But the market is calling their bluff. The yen is weak because traders don't believe Japan can handle higher rates without breaking something. Watch the yen. If it crashes to 160, the BOJ will be forced to hike faster than they want to. And if they panic, that shockwave hits your portfolio first. Thanks for watching. If you want to know how I'm hedging against a potential bond market collapse, check the link in the description. I'll see you in the next one.